Hi everybody and welcome to this special London session update, which is a preview of the June FOMC meeting 2013. What a pivotal meeting. The markets have been waiting for this for weeks. It's all about tapering. It's all about when the Fed could potentially slow down their QE3 program, so their big major asset purchase program. It's all about stimulus and liquidity, and we all know that markets absolutely love liquidity. So it's a nervous time for markets, especially if it feels like the Fed is going to start withdrawing that liquidity. Now, we don't expect them to take any action at the June meeting. We do think, though, that they will signal future tapering. So we think that they will say that it will happen in the future. Of course, it has to happen. And we think it could actually happen in the September meeting. But then to counter that negative effect, we do expect Ben Bernanke, the chairman of the Fed, to actually turn around and say that it will be dependent on the economic data that comes out between now and then, and tapering, the size of tapering, for example, will also depend on the strength of the economic data, and that they will be very flexible in the approach. Now, one thing we are looking for, there's two things really from Bernanke. He has got a tough job at this FOMC meeting and this press conference. The first thing, we're looking for him to really soothe the market, so soothe markets' fears. The second thing that we're really looking for is whether or not how many details he gives about the prospect of tapering. If he just turns around and says, yes, we're going to taper, but doesn't give any details, then we would expect a big sell-off in the markets and for volatility to shoot higher, because there is nothing more the markets hate than uncertainty. Now, let's take a quick look at the market action. I think some very level-headed commentators out there have made a good distinction. For economists, the Fed tapering doesn't really mean that much, because essentially there's still plentiful liquidity in the world. And remember, the Bank of Japan are buying a huge number of assets right now. But for the markets, it's a very different thing. They react so quickly to changes in Fed policy that even tapering is having a big impact. This chart in front of you shows Treasury yields, which is the line still moving higher, and dollar yen, which has come off the boil, backed away from those 105 highs, or just below 105 highs. Really, it's the first time for a long time that Treasury yields and dollar yen have been moving in the opposite direction. The reason why, we think, is that the dollar is moving more with stocks, and the prospect of an end to QE is really freaking the markets out, which is causing an inflow into safe havens like the yen. Now, what we do think is that in the short term, we could see further yen weakness, but we do think kind of 91.50 towards 90, very, very good support in the aftermath of this FOMC meeting as the market is digesting what it means for markets, with the upside being, really dependent on pretty much what the Fed says. We do think that over the longer term, though, that rising bond yields will have a mildly bullish effect on the US dollar, but it may not straight away. In the past, we've seen the end of QE actually lead to some dollar weakness. So there could be a bit of volatility towards the end of this week, over the next 48 hours or so, and that would be completely normal. But we do think that the uptrend is still there in dollar yen. Obviously, 93.60, very, very important level for dollar yen. It's a 38.2% retracement of the November down move to the highs from earlier last month. So do watch out for those levels, and do watch out for any sharp drop towards that 93.60 level in dollar yen. Now, the second thing I want to show you is cable. We've seen a big move in cable. It actually got through after the CPI data out of the US and the UK on Tuesday. It actually fell through its 200-day moving average after